Hello, guys. What is happening? And welcome to tonight's live stream once again from my homeland, the UK, here in beautiful Worcestershire. Funnily enough, the sky, I know you probably can't tell on the camera, but it's actually cleared out. This is the first clear blue sky I've seen since we arrived here over a week ago or whenever it was. I've lost track completely now. So, anyways, we got a couple of things that I want to go through. One, I want to go through the home capital group and what happened in 2017. I think that is an important thing to go through at this point as we turn the page in the cycle, let's say, for lack of better words. And I also want to go through an article that came out by the Financial Post just today, I think, or yesterday, or whatever it was. So that's an interesting article. Then we'll flip over to the markets, take a look at what's going around. I know it's kind of gonna be actually closing. I think it closes at 9:30. I'm not even sure. I'm not trading whilst I'm out here because the time difference is just ridiculous. I don't want to trade later on in the day, and it's a welcome break for me because I had a massive February, an absolutely terrible March, and it's a welcome break from trading. It can be intense when markets are as volatile as they have been over the past couple of months here. So interestingly enough, we're going to go through this stuff. Welcome, Silverchair, The Guardian. Nice to see you guys here. What you're saying here. With the insane debt levels Canadians have, including the private debt sector and the government, I don't see how it is remotely possible to not have a major correction at some point. Yeah, you're spot on there because you can't. There's no way that you can just avoid the inevitable. I mean, you can blow the bubble bigger. Is that possible? Yeah, totally. But at the end of the day, just by doing that, you're just kicking the can down the road and making the situation and the outcome even worse. But I think now Trent's in the house. Let's do this. Yeah, let's do this. The thing is now, I think we're at a dead end, and we'll go through that a bit later on and kind of dig into that. But yeah, like we're essentially coming to this dead end of modern monetary theory, and a lot of people have built their portfolio, especially retail investors, around modern monetary theory, which is just that the government can endlessly print money, for lack of better terms, without any consequences. And we're seeing real time that there is consequences. And not only that, the countries that produce the products and stuff that we now consume don't want to pay for our debt. And that's essentially what's happened. So we are seeing a shift in that. There's no way the West can turn around that train. And they really shot themselves in the foot with the sanctions. And not that I agree with what is happening in the Ukraine. I try and don't have opinions on that. You know, I don't support war, as you guys know. But it is interesting, isn't it? Because they've essentially sanctioned themselves. And I'll link a video in the description. And if you're on Spotify, I'll also throw a link in there as well. And basically, go and watch that. It's about a 30-minute whiteboard video from George Gammon. It's pretty in depth, but it's very interesting what he's talking about on that whiteboard video. And I think anybody really needs to hear that what he's saying. And he's been blowing this trumpet for a while now. You know, a lot of us who've been on the side that we're on have been talking about this for a long time. And it's only just now that this stuff is really gaining traction in the mainstream a little bit. So anyways, let's scoot on over. I'm trying to do this on one screen, so bear with me. Oh yeah, it would help if I put it on the screen for you guys, wouldn't it? So basically, I saw this and I just thought it brilliantly encapsulates the disaster, or one component of the disaster that is coming in the debt avalanche. And faster rate hikes cooling home prices could put the squeeze on home equity line of credit holders. For those of you outside the United States and Canada, just to explain briefly what this is, we have a lot of viewers now that are listening through Spotify that are coming from Europe, believe it or not. And essentially, they don't have these kind of products. So a lot of countries in Europe, they certainly don't have them in the UK where I'm at right now. And that's essentially, you can just use your your house, if you have equity in it, like an ATM machine. It's just, whoever dreamt that idea up is a absolute idiot, just to say the least. And it's a derivative product. That's essentially what it is. But nevertheless, so let's dig into this. HELOC interest rates are variable, and many Canadians pay only interest, leaving principal amounts subject to rising rates. Okay, got a nice ominous photo of the one suburb in the GTA somewhere. The Bank of Canada is widely expected to raise interest rates again next week to combat inflation, possibly by as much as 50 basis points or 0.5%, a move that could cool home prices and put pressure on indebted consumers. Not just consumers, businesses as well. And then they got a little 8-minute video. But while much of the recent focus on Canada's residential real estate market has been on soaring prices and lack of affordability, issues that are expected to be addressed in Thursday's budget, addressed and not done anything about, I think will be it. It will just be like, we're doing this on the one side and we're doing this on the other side, so that the balance is just nothing. That one offsets the other. Like, they might increase the amount that you can borrow with an insured, or let's just call it what it is, subprime mortgage, and they can do that. Of course, it's just increasing the liability of the taxpayer when it all goes wrong. And then they could also like ban foreign buyers, for instance. So that would essentially cancel each other out. So yeah, you've got more demand on that side, but you've also got less demand. But it's also a small share of what the market is. It's more of a psychological impact, if anything, that these things may or may not have. And it's that just, I just ignore the government, because they are so dumb, so stupid, these Western governments, that they're just gonna completely decimate and destroy the financial system. So anyway, I digress. Issues are expected to be addressed in Thursday's budget. Less attention has been paid to what a combination of rising rates and falling home prices would mean for households that have been borrowing cheaply on lines of credit secured by their homes, also known as HELOCs. So another interesting point about HELOCs and what they're using this for, a lot of these people, especially elderly people, are using it to give money to their siblings. What am I on? Not their siblings, to their sons and daughters. They or in between, whatever you want to call it. But basically, they are using to give this money to them, and they're using the home equity line of credit. Now, it's not just that. People are using it for investment properties, is a big one that people are using it for. And you have to remember, these products were really brought about for a short-term emergency lending facility that is now being used for long-term lending, and it's been advertised that way. And it's sort of been almost like the banks are like loan sharks. I mean, they just want to lend, lend, lend. That's their business. They don't care about you, the end consumer. They just want to lend, 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 because that's how they're making their money. And you have to remember that the people who chair these boards are just like the elected politicians. They don't really care about long term. They just care about making the dividends as fat as they possibly can in that given moment for investors, making their bonuses as big as possible in that moment for themselves and the other members of the board. And that's all they really give a toss about. They don't care about the longevity of the bank or anything like that. And we've seen this time and time again happen throughout history within the banking system. Hey, Cowson's in the house as well. How you doing, buddy? We got Mark in the house as well. Is a pint still 83 pence over there? Well, it depends where you go, but no. You can get a pint. I mean, I don't drink alcohol. I should really know this though, shouldn't I? But I think it's around £3 or something like that now. But you go most pubs, you're paying £5, £6, £7 a pint right now. Actually, funnily enough, the restaurant we are at last week, it was £7 for like a half-litre bottle of Peroni, which everybody knows, the Italian beer. And you know, that's so expensive. It's just unbelievable. And you know, it's funny you bring up that, but obviously alcohol and television, two massive parts of the British culture. And I know it's a weird thing to say that. Pence, yeah. So 83 pence is basically 0.83 of a pound. So yeah, I forget about that. But yeah, pence is just cents essentially. So yeah. All right, let's get back over to this. Oh, I need to remember to do this because I can't see this on my second screen. So yeah. So it is interesting, this home line of credit situation. We've talked about it before. Because HELOC interest rates are variable, rising interest rates could make the cost of borrowing much higher than when a borrower withdrew money, said Michael Toop, a spokesperson for the Financial Consumer Agency of Canada. Sounds like a government agency. This could put pressure on a borrower's ability to pay down the credit line while also having to manage other expenses. So he mentions other expenses there. What other expenses is he talking about? He's talking about inflation and the many things that are soaring in prices right now because yours and my government have lost control of the financial system, and the central planners and central bankers, they've lost control now. The control is gone, and people just don't realize that yet. And I hope people really awaken to that, because those that awaken first are going to be able to prepare for what that means. And that means that you need insurance if you're holding lots of cash, whatever that may be. For me personally, it's gold and silver that I hold as insurance, and that's physical metals. And as I always say when I mention gold and silver, store it in a vault, be smart, put it somewhere that you can access anytime, 24/7. However, that's safe and not in your house, in my opinion, because people, burglars, robbers are going to be looking for gold and silver when they break into people's houses. Especially, they know it's gone up in price a lot, and it's easy cash to get that stuff. That's the first thing they're looking for. If it's in a safe, it's just obvious to them. They're just going to take that safe straight out. So, or put a gun to your head and ask for the code for the safe. So just be smart about it, because I know a lot of people think, you know, I'll just throw it in a safe and it's all good. But honestly, that isn't a very smart decision, in my opinion, anyways. You know, people these days, they know all this stuff. They're not stupid. Well, they are stupid because they're robbing houses, but they're not that stupid. Um, Regulators are already on high alert concerning a popular loan product offered by major financial institutions. We should do a separate live stream on this entirely, that combines both a mortgage and a secured line of credit, because the loan can be up to 80% of the home's value compared to 65% on a traditional secured line of credit. The OFSI or OSFI or whatever it is has been keeping an eye on these popular loan products and how the banks handle them. They now represent a significant portion of Canada's uninsured household mortgage debt. So again, it's like an afterthought, isn't it? They're now looking into it. it's already a significant amount of the mortgage debt. So, okay, they're looking into it. I mean, it's just completely ludicrous, isn't it? When you really think about it, you just got to boil this down and pull these things apart. And when you dissect them, you just realize that it's so much worse than everybody's making out. And I don't mean to be the person who's here being doom and gloom. Um, I'm just a realist, essentially. And one day when everything is collapsing and going wrong, I will be there and I'll be saying, I'm buying this, I'm buying that. And a lot of people will be looking at me like, you're an idiot, you're getting it wrong. Just like a lot of people looked at me when I said that essentially the housing market is going to collapse. And the start of that collapse will probably be, I didn't say with any certainty because there's no certainties, only probabilities that will happen when interest rates start rising. Um, so it's just a significant thing. So it's a significant portion of the debt the OSFI is admitting, and they're looking at it. So it's already happened. So they're screwed. But again, it's like the subprime mortgage crisis in the United States when they said they were looking into that, when Bear Stearns and everything said that they were the subprime losses, they're only small. Don't worry about it. Just look at this golden pony over here and just forget about that. And, people push these things into the background. And that's why we're going to be going through that home capital group, because I think that's incredibly important as well to look back at history and see what's happened and why that happened and how the banking system is not as secure as everybody is led to believe in any Western country, essentially. So it then says Peter Rutledge, OSFI's superintendent, what a name, highlighted a tail risk associated with the combined loan product in a January speech, noting that it dynamically readvances credit to mortgage holders as they pay down their home loan. He was building on comments he made in a speech late last year, in which he pointed out that borrowers can elect to pay only the interest on these lines of credit and even use them to pay their mortgages in times of financial distress. So you've again got this thing where people are over leveraged. They probably couldn't even afford to pay it down. So they're just paying the interest on it. It's absolutely hilarious. Rutledge, a former bank analyst and finance department official. Isn't that funny? He's in the government's OSFI and he worked at the bank. I mean, guys, this doesn't surprise me, but again, it's showing you in plain sight that the whole system is completely broken when you've got these people who work at the OSFI, which is meant to be regulating and protecting the financial system, and they're coming from the banks and the institutions that they are there to regulate. That represents a massive conflict of interest. I mean, do you not think that some of these people are in bed with other people at the banks? Like, of course they are. Is there back end bribes probably going on? Of course there is. I mean, we don't live in a perfect world where everything is amazing. We live in a world that is far from that, as you guys know. But it is just crazy. Hello, Free Green Living Co. and Trader 586. So yeah, I mean, I just find this absolutely insane that when these articles come out, people probably don't even pick up on these little nuances that actually mean a lot, and that's why we go through them on this channel. But anyway, so where did we get to? So in his speech at RBC's Capital Markets Canadian Bank CEO conference, what a mouthful, Rutledge suggested OSFI was considering changes to its B20 guideline. So it doesn't even sound like a rule. It just sounds like guidelines are just guides at the end of the day. You don't have to follow them. They're not rules. Um, which instructs the banks on practices and procedures for residential mortgage underwriting to make sure banks are meeting OSFI's expectations for combined mortgage and HELOC loan products. Non-traditional housing-backed products can lead to greater and more persistent outstanding principal balances, increasing risk of loss to lenders. In response to questions about the impact of a potentially softening housing market, an OSFI spokesperson said a decrease in house prices would not necessarily trigger any action on the part of the banks. However, as per B20, OSFI expects that financial institutions should review the authorized amount of HELOC where any material decline in the value of the underlying property has occurred and the borrower's financial condition has changed materially. She said, adding that this expectation also applies when a HELOC is part of a combined loan product with a mortgage. So I want to highlight that because that's incredibly important, isn't it? Because when you really think about it, that what they're saying there is so important. But basically, they have this regulation or whatever that basically means that they have to review the borrower's eligibility for these products when the prices of the underlying assets decline. And that's going to mean that a lot of people are going to be asked to cough up money by the banks and the financial institutions. And it might even be regulatory. I just thought they would do this as a case when it starts happening, but turns out there's actually regulations behind that that force them to do these such reviews. Now, it doesn't mean they'll do them. You think the banks, I mean, the banks are in the driving seat, in my opinion, not the OSFI. But then again, it's money to them and it's risk exposure. And the banks are going to be changing significantly as housing prices start to decline. It means that their risk exposure increases massively at a compounding rate because of products such as these products that we're talking about right now that are incredibly important. So the features have made combined loan products a popular choice, particularly with interest rates at record lows. You hear this time and time again, guys. We hear it all the time. Record low interest rates, record low interest rates. We go round this merry-go-round talking about it. But the thing is, yeah, that is why these products became very palatable to investors, even retail investors in the housing market. So, they thought, wow, rates are low. I'm not getting a return on my cash in the bank. Let's sink some money into a house, get some weird product that we only have to pay the interest on, and then we'll just be rolling in it and nothing will ever go wrong. And they don't understand the products. The fact is, the retail investors and the people who are taking out these loans and products, they don't understand them. They don't understand them at all. I mean, you think people read through the hundreds of pages of a mortgage when you have to sign your mortgage? There's hundreds and hundreds of pages. I've seen these contracts. The thing is, you need a lawyer to sift through that, or somebody, financial advisor, and point out what are the pros and cons and everything like that. But people don't. They don't have the money. They don't have the time. It's all in a rush. They don't understand what's going on. They're just emotional about the house. It's such a rush, and we're bidding over ask, and we're happy to just get the financing, to be honest, because we bidded over ask on that price, and that we were worried about the appraisal. These these are the things that people are thinking, like, yeah, the Trader 586, you're exactly right. The whole thing is the Canadian version of The Big Short. It really is. I mean, they've done and created exactly the same recipe as in the United States. And it's really going to be interesting because they don't have that backup that the United States have of having a reserve currency. It's a currency with no backing apart from the United States and the United States dollar. That's essentially what backs it. So, according to the figures compiled by the Bank of Canada, combined mortgages and HELOC products grew to 710 billion at the end of the last year, representing 41% of total real estate secured lending. Their share rose from 37% in the first quarter of 2019. So that's significant rise, and the outstanding amount should just make people fall off their chairs. People seriously don't understand what's going on because you hear these numbers, $1 trillion outstanding, 740 billion outstanding, all these numbers. But what people forget is the combined wealth of everybody inside the country does not amount to anywhere near these numbers. So essentially, it's a pyramid scheme in the sense that at some point, the pyramid has to be flipped, and it's going to be the people who are going to be at that bottom of the pyramid who are going to be the worst off and absolutely destroyed as the weight of this debt thing crushes everybody beneath that top layer. And it's really interesting when you just put it simply that there is not enough money to pay off all these loans. When you put it as simple as that, even a 10-year-old could understand this. If you have $10 billion of loans and there's only $5 billion in the economy, how is that loan going to be paid back? And this is the thing people in Canada do not understand. It's very, very simple. You don't have to be a mathematician. You don't have to be a genius. You could be a 10-year-old. And it's that simple. There is not enough money to actually pay off all these loans and products and everything. So it's a Ponzi scheme, and it's going to end. It's going to end. And that's what people don't realize. People can't see a trend when it ends. Recency bias, normalcy bias. Funnily enough, I talked about this in a video that I filmed today, which will probably be out in a couple of weeks. And if it wasn't too windy, because there's been a hell of a windstorm here in England today, and I filmed it, and the wind was just insane. But yeah, so it's just a Free Green Living Club. BlackRock and Vanguard will buy all Canadian property during a housing crash and then rent out higher. I don't think they'll buy all of it. I think they'll be dealing with massive losses themselves. I don't think it's going to be as simple as they would buy if the rates were low and the returns that they were getting on bonds were really low. And I don't think we're ever going to that. I don't think we're going back to that. I really don't. And I could be wrong. There's always a chance that I'm wrong. But I just don't believe at this point the probability of that happening is high enough that I make a consideration for it. I just think that they'll be sticking with bonds. They'll be selling a lot of their real estate. And again, George Gammon did a great video on that, Free Green Living Co. If you check that out, he did like a whiteboard video a couple of weeks ago. It was fantastic. Benjamin Frost is in the house. People don't even get a home inspection. Never mind read the contract. Yeah, you're exactly right, buddy. That's exactly the thing, isn't it? They don't do the home inspection. They don't do anything because they are FOMOing in. They just want to get the house at any cost. They do not care if the house is falling down or whatever it is. That is a mania. That is exactly what a mania is. When people just ignore all sense of normalcy and just go insane. It's like a bipolar disorder. And essentially, when I say bipolar, obviously you have that when they're just euphoria. And I've known, prior ex-girlfriends that I had bipolar, and dealing with that was just very difficult. But because they are essentially one time just absolutely manically depressed, and the next, then they're absolutely happy on top of the world, like you wouldn't believe it. And the thing is, the markets are like that too. If you have that one side, you're going to get that other side where it's just manically depressed and it just collapses. So it is inevitable. But yeah, so it's really cool. So I've lost my place in the comments right now. I'll get back to those in a second. Let's just get through the rest of this. What time is it over there? It's gotta be, I don't know. I can't do the math on that. It's 8:30 p.m. here, as you can see. The sun is just going down. That's a blue sky. The first one I've seen that's been clear since I came here. So what we got here, we did that. It's quite substantial, yeah, no kidding, said Jason Mercer, a vice president. I find it so hard not to use profanity on those, but if I do, it limits the audience that see these videos, so that's why I don't do it. But it's so hard sometimes not to use profanity. Um, the senior analyst at Moody's Investor Service, because they did such a great job in 2008. While borrowing above 65% of a home's value is usually subject to amortization over a set term like a traditional loan, the analyst noted that the amount in these combined products that is not amortized, meaning it is treated like a conventional home equity line of credit, where only the interest must be paid and there is no set term for the loan, is now double the size of standalone HELOCs. Mercer said that banks track loan to value ratios at 2 points when the home is purchased, and again if there is an updated property appraisal, which can trigger an increase in borrowing limits if house prices have risen. But they should say if it declines, I would think. Yeah, they do. So falling housing prices could lead to problems, he said, but not right away. First of all, there would be a 20% equity buffer before borrowers were underwater, and the problems would only materialize if they sold the home. Even if the mortgage value was above the value of the house, borrowers who live in their house likely wouldn't sell and realize a loss, Mercer said, adding that those who remain employed are likely to continue to make monthly payments. He's spot on there because he mentioned a key point, which I've said time and time again, and was the reason why we didn't have this disaster that happened in 2008. And that is because unemployment was not sustained long enough. The recession, I think, if you look back, off the top of my head, I think it was about 10 months or even less, 8 months in Canada or something ridiculous like that. The 2008 actual recession. So it was not a long recession. Canada hasn't had a prolonged recession since the late 80s, and even that wasn't a big one. So the one it's due is monumental in proportions. Now, he mentions a good point. If they can continue to make their monthly payments, and that's just it, they're not going to be able to continue making their monthly payments. And then you must add the fact that people buy investment properties in Canada not for the rental income, they buy it because of the future price appreciation, because these people are clueless. They don't understand simple economics, that basically there's not enough money in the system to pay the loans that are outstanding right now. So yeah, they can speculate on housing prices rising, and there's always a slight chance that housing prices are going to rise, especially if interest rates are falling. However, you have to acknowledge the fact that at some point there's going to be an end to that, and it's generally going to be when interest rates have to rise because of other circumstances like inflation, the rising cost of living. And it's a toxic combination because you can either take one drug that's going to kill you or another drug that's going to kill you. One is obviously inflation and the other is rising interest rates. And likely it will be a combination of both that does it, but they're not going to have the buffer that they had in the past, which was just to fall back, start lowering rates, quantitative easing, all the rest of it that just really kicks the can down the road and creates more stagflation and everything like that. It's been proven time and time again. So yeah, it's ridiculous. So he really points that. And then another thing he says in that line, realize a loss. They're likely not going to sell and realize a loss. But obviously, like I said, if they're an investor, which we know around 20-30% of all the buyers over the past 2 years, around that number have been investors. And basically, they are buying that property mostly at a negative rental yield because they're literally negative on the rent. They're usually adding to it. They usually don't even calculate whether they're going to make money or lose money in the end. They're probably just thinking, we'll just use it as a saving account, and then it'll just be worth $1 million. And they might have even paid more towards it in maintenance fees and everything like that than it's made in rent, that it offsets completely what they sell it for. But in the mind of a dumb investor, it's a great investment. That's just the way it goes. That's just the way the cookie crumbles in this instance. But yeah, people are going to sell and realize a loss. You bet they're going to sell and realize a loss, because as soon as those investors get fearful that prices are going to seriously take a dive, a lot of them are going to think, hey, we'll just sell it and buy at a lower price. Some of them are going to fear that they're going to lose so much money. Others are just going to walk away straight up. Many of them go back to their own country if they're new immigrants or whatever. Renters are going to leave, new immigrants, because jobs are going to disappear, meaning that landlords don't have the renters anymore, or they're lowering the rents. And it just creates this funny thing that just hasn't really, it's sort of started to happen in 2020, but that was really nothing compared to what we're going to see because of all this can kicking and this inflation cycle that they've started, which I believe will probably last 8 to 10 years. So you're in for a bumpy ride. And in one of the videos that I filmed yesterday, I think it was, I'm talking specifically about how you can help yourself just get out of this situation, which is going to be a massive economic recession, high taxes, austerity, declining public services, all the rest of it. It's all coming down the pipe, and people just don't realize it yet in Canada. And I've seen it here in the UK, because after 2008, that's exactly what had to happen here in the UK. So still, the Financial Consumer Agency of Canada has expressed concern about how HELOCs are being used since 2018, after finding that a substantial amount of Canadians were paying only the interest, leaving the principal amount subject to rising interest rates. Just take a drink there. Yeah, so it's exactly that. It's just insane. It's just exposure is just huge. One observer suggested the interest only model is akin to a credit card, although interest rates on secured lines of credit are markedly lower. The popular credit lines secured against a home can be used for large house-related expenses such as renovation, but there is no requirement to use the money for any particular purpose, and balances are subject to prevailing interest rates. And while many borrowers don't realize it, full repayment of the loan can be called at any time by the bank, unlike a traditional mortgage. You know, I'm so glad they hit that, because I was trying to do a video actually on this a while ago, and I couldn't find the information anywhere about it, because I wanted to do a video on HELOC in particular. And this is, again, they just put it so funny, don't they? Because it's just like, oh, it doesn't matter. It's not a big deal. But many borrowers don't realize it. Full repayment of the loan can be called at any time by the bank. And that's exactly what happened in 2008, guys. Grant Cardone was in court with a lot of banks fighting, because the banks were calling in his loans saying, we want you to, because they were all in crisis. trying to raise cash. And the thing is, people just can't see it. Lending conditions are shifting right now. Liquidity is drying up. And this is before the Bank of Canada and the Fed have even done quantitative tightening, which is essentially sucking more credit out of the system. It's creating a vacuum, and it's just insane that nobody is really, like, a lot of people just probably think that, oh, by the end of the year, prices are going to be rising, the market will be back to normal, and there'll be no worries about a recession. Because if there is a recession, the central banks are just going to are just going to lower interest rates, because that's what they've done in the past, recency bias. So yeah, they're hugely exposed. Another thing that they don't mention, maybe they do further down, so we'll skip over it if they do. With a HELOC, if your home value declines, the bank is going to call it in. They're going to say, hey, you at least need to pay back the money that your home is not now worth, because of regulatory concerns and the fact that assets and liabilities are going to be so out of whack on their balance sheet, and they can't cover that over. So so they are going to be calling these loans in. Little do people realize. And they're going to be forced to sell. And all these people are going to be forced to sell at the same time. It's like they're just waiting around. It's essentially like a margin call. That's what it essentially is. And it will happen. And this is what happens when you use leverage. I trade on leverage. I know a lot about leverage, and leverage can be very dangerous in the wrong hands. And people, retail investors, they do not understand leverage. Like, I could go leverage a couple of millions of pounds right now to bet on the SPY and blow up my account within literally an hour. So it's just kind of, you have to realize that leverage compounds your losses as well as compounding your profits. And people only think about the profits, and that's where they get things just so messed up. It's just bad investing type mentality, the worst kind, and that's what it really is. But that is a key thing. I should put that in the title after this, because I think that is so key. Back in 2018, FCAC flagged a pressing need to help Canadians realize that not using HELOCs responsibly can have serious repercussions on their financial well-being. Concerns about consumer exposure to rising rates have only increased since then. Yeah, it just goes to show. Clara Vargas, Senior Vice President of Canadian Structured Finance at DBRS Morningstar, said rising interest rates will add risk and uncertainty, particularly to loan products that combine mortgages and HELOCs, which we know are now a substantial amount of the market share, and the OSFI is looking at it. They're looking into it right now. I mean, God, the clowns. They'll come out and regulate it, but the damage is already done. It's like the foreign investors. That's in decline right now, and they're about to ban them. So I mean, yeah, whatever. I mean, that might impact psychology a lot, because because a lot of people believe wrongly that a lot of people are coming in, like all this cash from overseas is coming in, flooding the market, and that's the reason why prices are going up. And that ain't the reason. It's because people speculate on stuff like that domestically in Canada and the United States. It's not because of that money coming in. God, I mean, every country in the world, every real estate market has foreign money coming into it, and not all of them are going up right now. That's just not the case. So you just have to look outside your own country and look around the world to realize that that's just a load of garbage, essentially. But she said the risk of default on such debt, which could hurt the banks, is mitigated by factors including tight underwriting standards. Yeah, right. That includes stress tests along with recovering labor market and recent property value appreciate. I mean, that is just a load of garbage. Just ignore that completely, because we've gone over this in multiple videos in the past, and it's just not worth wasting your breath on. The underwriting standards are just terrible in Canada, way worse than even the United States right now. One of the worst in the West. Vargas said that if house prices fall, borrowers who find themselves in arrears could find they are unable to generate proceeds sufficient to repay the mortgage and the other house-related debt. However, the risk is more correlated to unemployment, as I've been saying, and would also depend on how much equity there is in a property. And what do we normally see? We see record low unemployment rates right before it spikes to record high unemployment rates significantly, funnily enough. On a national level, Vargas said the real estate equity ratio has increased to 76.5% from 72.3%. Again, that's significant, which includes homes that have already been paid for in full. That's just house prices could come under pressure on a number of fronts. Federal budget, we're not going to go into that, and the interest rate announcement, you guys know about that. And then it's they got a mortgage broker on here, and saying that it's going to be anyone with a variable rate mortgage should budget for additional rate increases totaling 1 or 2% for the remainder of the year. Okay, yeah. They should budget for it. They ain't got no money anyway. So I don't know what this guy is on. I think he just thinks that people are going to find money under the mattress. The only place they're going to find money is taking it out there. Home equity line of credit and plumbing that in. And then the bank's going to be calling that in when prices start. The recipe that has been created, you have to laugh, because I think that to not be able to see this is just somewhat of a skill and an art that I could never master. I just really love to have somebody meet me in a pub and just explain to me exactly how they've come to the conclusion that housing is going to continually go up for the next 10, 20 years, because they're just completely out of their mind. So we're going to move on swiftly now to Home Capital Group and what happened in 2017, because that's important to note. Some of the things that happen when a bank, even though it wasn't really a massive bank, it was a lender, and it was a small one, albeit, but it did have an effect on markets, especially the currency market, which fell, which would send inflation further. And I expect the same thing to happen. The currency market will fall when this crisis ensues, especially if the United States is not in crisis before us, which I don't think it will be. I do think it will be at some point, but I think it will be after Canada and not before, just because of where different countries are in the cycle, and New Zealand will be before that. So let's take a look in the comments here and see what's going on. BlackRock, yes, I've been through that. Be a quick U-turn in interest rates during the crash, maybe not. I think the probability, it depends on inflation. That's what we really have to bear in mind here. That's what interest rates are really going to be focused on, as they are right now. They know, well, I think they know anyway. Revert to Means is in the house. Check out his channel, great guy. We're going to do some more interviews, I'm sure, when I'm back in Canada. Recent home buyers got FOMO'd so bad. Cheers, mate. That bipolar comment had me laughing. Yeah, it really is a bipolar market. That's just what it is. TIFF won't have a choice the way bonds are acting. It's very true, Trader 586. You're exactly right. You know, the bond market, they don't have a choice. Their backs up against the wall. Most large farmers in my area do not own their equipment or land. How many will go bankrupt due to rising input costs of fuel and fertilizer? You make a great point, because this ranch that I know two ranchers of who live in southern Alberta have said, like, they don't have any water for the cattle. Like, It's just bad, the feed they're not going to be able to put them out into the fields and onto the pasture. So that means they're going to have to pay for feed, and the cost of feed has skyrocketed because of the drought that's going on. Food prices are just not coming back down. And what you mentioned there is, like I say, inflationary cycles. They don't just start and stop. These things are longer lasting. We're not going to see the repercussions of these things that's happening with food for a couple of years, maybe, but they're going to come along and it's going to increase inflation. And that's really how this cycle is generally longer than people think. It's really not like it's going to be over as soon as there's a recession. Certain things may fall in price, but a lot of things like food, energy, they may still be going up in price. And those are the bare necessities that people cannot really cut back on. So it's a perfect storm. Free Green Living says, I agree with you totally. Revert to means, exactly. Perfect storm of cyclones. G. Ellis is in the house. They will raise rates until the market begins to crash. Then they will hold the rates or drop them somewhat. So we will be screwed either way. In the inflation will continue to run hot. I mean, I don't, I just think if inflation is running hot, I don't think rates are going down. They might hold rates, try and come up with different wizardry that they can navigate and make things better, which aren't going to work. Stimulus programs, everything like that. They'll just create more inflation. Trader 586 says, in the 80s here in Alberta, people walked away from their mortgages and just mailed in their keys to the bank, jingle mail. Yeah, that happened in 2017 actually as well, and in 2008. And it'll happen again. It's just a matter of time, and it's really the people who are really going to be screwed are anybody that came from like Ontario or BC thinking, hey, you know what, the price of properties here is less, I'm just going to buy because it's cheaper. I mean, what a just genius move that was, really. I remember those days in Alberta. Couldn't find a job even if one offered to work for free. Yeah, we'll end up there everywhere soon, unfortunately. I had a HELOC, called it in '06, learned my lesson. It was called in. So there you go. HELOC called in, revert to means. First and last says, I beat the selling rush and sold last year. No more HELOC or any debt now. Waiting for the bubble to burst. Good for you. You cashed it in. Most people aren't going to do to that. So we got to say kudos there. How many silver ounces do you think should buy a house? I have no idea. I'm not that good at math. Or gold ounces. Yeah, I mean, could be, 10, 20, 30 ounces soon enough that's buying a house, or even less. Inflation will stop immediately when the Fed pulls a Volcker. Yeah, and I essentially, that's what they're setting the stage for. But again, nobody listens to these things because it's all recency bias at the moment. Everybody's soaking up what they have seen for the past 20 years, thinking it will continue indefinitely. And once again, I'll link that video. If you're listening on Spotify, I'll also link it in the description of the podcast. So go check it out from George Gammon. It's about 30 minutes, but it's a great video. Really go check it out. So basically, we're just going to take some of the snippets from this article here, which is about Home Capital Group in 2017. And then we'll go over, take a look at what's happening with bonds. And then we'll wrap it up. We'll wrap this up. So, and I think I'll probably do some sort of wrap up tomorrow. So I might not bother with the markets. We'll see. So anyway, everything you need to know about Home Capital Group's woes and the impact on the housing market. We're not so concerned about the impact on the housing market because that's happened. But we're more concerned about what happened and how they got into real bad trouble. So the company's problems began last week when the Ontario Securities Commission alleged that several company executives broke security laws, surprise, surprise, and misled shareholders in their handling of a scandal involving falsified documentation for a bunch of mortgages almost 2 years ago. A bunch of mortgages. In the summer of 2015, Home Capital Group announced it had cut ties with about 45 mortgage brokers for fudging the numbers as to how much prospective borrowers were earning when they applied for a mortgage. Home Capital said at the time none of the borrowers in question had any problems paying off their loans, and the company's financial results since then have backed that up. So that is essentially 2008 stuff. This is just 2008 stuff, but there was no unemployment crisis that resulted in these people losing their jobs and not being able to pay back their loans. At the end of the day, it's not rocket science, guys. If a lot of people get mortgages who can't afford them, the buffer that they have is small. So if one person in the household loses a job, they can't afford the mortgage payment. Whereas if it had been a qualified buyer, they might have been able to afford that mortgage payment with one person at work. Now, that's not the case because I've gone through these processes myself, and I know for a fact that the risk exposure is absolutely gigantic. So I know firsthand that people can borrow up to their eyeballs more than they can afford to pay back. And they don't ever take into consideration the fact that one person could be put out of work, and then how are we going to pay back the loan, especially if prices are falling? It's always like, well, prices are always going up, so we don't necessarily have to worry about that. Just forget it. But fudging the numbers, again, this is mortgage brokers fudging the numbers. Still going on today. We've covered it in the fraud videos, which I'll also link in this live stream, and the podcast from previously last year, where we went just to Reddit and pulled some of the fraud that we just found simply searching Reddit boards. And it was funny at that. Maybe we should do another one, see what else we can find. It was good. So in the summer of 2015, Home Capital Group announced it had cut ties. Oh, yeah, we did this. Sorry about that. But the company's stock was hit hard this week as the OSC allegation spot fears the company may have loaned out too much money to home buyers who may not be able to pay them back in an overheated housing market. Home Capital shares plunged 65% on Wednesday amid those fears, and a word that savers were withdrawing money. They rebounded a little on Thursday after the company secured a $2 billion line of credit from the Healthcare of Ontario pension plan. But a cloud of uncertainty remains, especially that lifeline comes with a catch, an interest rate of more than 22% on the first $1 billion. Usurious rates like that stoke fears the company is desperate for cash, could further contribute to a run on the bank. Analyst Mark Charbin of Laurentine, whatever bank, noted this week. So that's interesting because it was essentially a bank run that was calling it in, and it was just fear. That's all it really was. Fear, and that's all it really takes, and people don't know this, but this was obviously like a tiny lender, tiny section of the market, but the currency tanked when this happened and it was down significantly. But the thing people don't realize is it's crazy. When you really think about this stuff, you have to realize that it's really a lot of psychology that is playing into these different things. It really is. So I find it incredibly interesting. But yeah, so we'll continue on with this. I just realized though, I'm running on battery. I really should have plugged this into charge. Savers have been pulling the money out of the company at a feverish pace all week. At the end of March, Home Capital had about $2 billion in cash savings. By Monday, that figure had fallen to 1.4 billion. By Friday, it was about a third of that. The fact that many investors are withdrawing their money as a precaution is bad news for home capital. But the real pain could come later this year when the 13 billion they have in locked GICs is available to be taken out. If investors pull the money out of that, that will exacerbate the problem even further, said Cynthia Holmes, a professor of real estate management at Ryerson University, Toronto. It's a serious problem when their deposits dry up because they have to offer higher and higher returns in a vicious circle to attract new investments. And this is really key. Paul Harris, a partner and portfolio manager with Avenue Investment Management, says home capital has a trust issue, and that's often the beginning of the end for a financial company. Now, in the case, we know that Berkshire Hathaway stepped in and bailed them out and whatever, and got a significantly big stake in the company. I think they took it over even. I can't remember the details on that. But anyway, what he's highlighting here is it's often the trust issue that's the beginning and end to a financial company. And I think that trust was really knocked. And a lot of people realized that during the trucker convoy protests when bank accounts were frozen and all that happens. And it gets brushed under the carpet. People forget about it. But that's really the thing that people should really be thinking about. It's all psychology. It's not so much everything is rosy in the world. It's all psychological. So, Home Capital Group essentially is still going today. But in the case that there's a banking crisis and prices fall 20% or more, that 20% is really the golden number, it seems. Once it falls beyond 20%, the housing prices, that's when you're going to see significant problems arising in the financial sector in Canada. And I believe the Equitable Bank and First National Bank have massive exposure as they have literally been writing mortgages at rates less than bond, and they have exposed themselves hugely to risk. But it will be the big banks too, and there won't be these line of credits that are offered because, quite frankly, there will be so much money that will need to be printed or made or constructed or whatever you want to call it to bail out these banks that it's going to be it's going to be a monstrosity of a loan that's going to need to be created by the federal government. And of course, I think they will be bailed out, and they'll probably go into public ownership like what happened here in the UK. Regulations will get tightened significantly, and anyway, after that, the rest of the story, where I think the Canadian economy is really heading. But we're gonna really, yeah. Brokers refer to means says brokers fudging the numbers. No way. Yeah, we never expected that coming. Real estate only goes up in Canada. Immigrants, millionaire refugees from Ukraine, supply shortages, maple syrup, etc. If you hadn't have put maple syrup on the end, I would have took that seriously, and I was just about to eye roll because we've gone over so many of those points so many times. Done them to death. DNPR. What was the money borrowed from healthcare workers' pension plans? It wasn't borrowed in the end. Actually, they never actually got that line of credit extended. Well, I mean, it was available to them, but Berkshire Hathaway stepped in and took them over. It was quite a weird one when that happened, to be honest. But yeah, so let's take a look at bonds right now and see what's going on there. I don't think the market is closed yet, but let's see what's happening on the market with the yields, and then we'll put a cork in it and we'll come back tomorrow and see what's going on. So, all right. So the 2-year basically unchanged at 2%. I mean, the 1 year, sorry, basically unchanged at 2%. That's not bad though, 2%. So GIC rates are probably pretty good just for locking up for a year. And I mean, I say they're negative, but you know, it compared to historically, that's not bad. Um, at least you're getting some sort of a return for locking up your cash, I suppose. I don't even trust the Canadian government to pay it back. So bond yields flat up 2 basis points. You know, yesterday, I think they touched 260, which is just insane. So bond yields have been touching like record historical highs and have been pulling back recently and kind of been flat essentially, but still high. So essentially, you've got the 5 year, the 10 year. So yeah, the 5 year still inverted over the 30 year there as well, and the 10 year at 2.57 and the 30 year at 2.51. DXY is up. I saw as well that is very interesting. Let's see if that's still the case. We'll go to Yahoo Finance right now and take a look. So let's see what's going on. Corporate debt is down. Corporate debt is down. J&K is heading under $100. So if you remember on the live stream, J&K was under $100 at one point, and then it shot up. We had the rally in the corporate debt market. J&K's junk debt, essentially, by the way. Create a watch list if you're listening for the benefit of the listeners, actually. Create a watch list of these tickers for corporate debt. They're good ones. VCB.to, XCB.to, LQD, HYG, and JNK. They're good ones to watch. I think I've got some others somewhere as well, but they're all down today. So corporate debt selling off, JNK selling off quite significantly. If we get into the chart on JNK, it's heading towards that $100. And if you're thinking, the market's shut now because we got after hours. So basically, it's down 0.20%. These bonds, the fluctuations in the price, remember, they actually mean a lot more. So if we look, J&K got down to under $100, and we did some live streams there and I covered it, and we're heading back down to it now. And if I look at it again and put it on the 5 year, you can see that clearly we are heading downwards under now on a sustained move to levels not seen since 2020, when the markets went extremely illiquid, when capital dried up and the crash happened in March 2020. We're seeing the same thing happen in the corporate debt market. That just means lots of businesses are going to go bankrupt, means they're going to be paying more money for interest rates, which means more inflation. It means they will cut back on hiring people, and it just means more of a stagflationary environment, essentially. So it's kind of crazy. Should we be moving money out of our pension plans? It seems like a collapse would bankrupt them. I'm not a financial advisor and I can't give you financial advice on that. So I don't really know. I mean, that depends on your personal situation and how your portfolio is positioned, who's managing your portfolio, what's in it, who has oversight and everything like that. But I would definitely be reviewing what's in the portfolio if you can, if it's managed by something else, what funds the pension fund buying, what essentially is the pension fund in, because I mean, a lot of pension funds will have been hit hard by the sell-off of fixed income assets, like we're talking about here, corporate debt. A lot of these pension funds own corporate debt, they own bonds, and they're all selling off. So the values of those are going down, and the yields are way below inflation. So the returns that are going to be generated are absolutely tiny, and they're negative in most cases. So that is all I got for you today, guys, thank you so much for watching tonight. Thanks for being here. I don't know what time it is over there, but anyway, thank you. Please do me a favor, hit that like button because that's going to help just push out the stream that helps the YouTube algorithm. I wish I didn't have to say things like this, but I have to say things like this. You can also check this out, the replay of this. It will be posted on Spotify on the podcast tomorrow. Link is in the description. You can follow me on Twitter. All the social media links are in the description. I'm active on Twitter at Market Mania CA. Also on Instagram, Market Mania Canada. Email is down below in the description. Everything like that. Oh, it's 4 p.m. Eastern time. Oh, not too bad, Eric. All right. Thank you guys so much for watching. I'll see you in the next one. Peace, guys.